Now, I'm sure most of you have used a screening platform. Very simply, a screener is a tool that helps us filter from thousands of stocks based on specific financial metrics. These variables can range from what you can find in financial statements like the balance sheet, P&L, cash flow statements. It also has price-based information like share price return, market cap, moving averages, RSI, etc. You can filter ratios like dividend yield, the P multiple, book value, asset turnover, and even non-standard variables like credit rating, Piotrowski score, analyst recommendations, and much, much more. Popular platforms include Screener.in, Tickertape, Trendline, StockEdge. There are a bunch of these now, including some AI-powered ones. But before we get into the prompts, the queries, I think what's even more important is for us to understand the objective, the insights we're trying to extract here. For instance, if I were to ask you, hey, what's the objective? What do you need from the screener? The most standard reply, most often what I get is I want a list of 10 multi-bagger stocks, which is fine, achhi baat hai. It's just that it's a bit too broad, which is why in this video, I'll be breaking this down into more manageable sub-goals. This divide and conquer part will become clearer as we go along, so let's begin. Right, so I've divided this video into two parts. In this first section, we'll focus on how to screen for companies which are going through certain situations that can be potentially profitable to investors like you and me. For instance, let's say we want a list of companies that are rapidly expanding their capacity. Why? Because more capacity might lead to more orders, and more orders eventually gets converted into more sales, at least that's the theory. Now, a simple way to identify such companies on a screener is to use the gross block or the net block functionality. So let's try this query. Gross block, that is current year's gross block, is at least 2 times of the preceding year. Okay, so that's a lot of companies. Let me sort it by market cap. And oh, okay, so we have Sky Gold here. Please recall I had featured Sky Gold in my newsletter, and the core of that story was an increase in capacity when the company moved from a 25,000 square feet facility to the present one that is 3 times the size. This led to a big jump in sales and profits, and that's the kind of businesses that we want to identify as a result of this simple query. Let's do a few more, and how about discovering some turnaround stories? So by definition, a turnaround is said to have happened when a company has posted 2, maybe 3 consecutive quarters of profits after struggling for several quarters. On Screener.in, this query would look something like this. And while glancing through the results, I couldn't help noticing Sami Hotels, another newsletter story which has delivered 4 quarters of profits now after many quarters and years of losses. Another situation, and a very interesting one, is spotting of efficiency improvement. Now, efficiency can be explained in different ways. For example, there's ROCE, return on capital employed, that explains how efficiently a company is generating profits from its total capital, that is both debt and equity. So with this query, we can see companies that have been consistent with their ROCE number over many years, going as back as 10 years. The same efficiency concept can be applied to operating margins, that is EBITDA divided by sales, and while one has to account for sectoral cyclicity, any visible growth in margins is taken as a pretty positive sign. Some other variations of this include looking for price breakouts using moving averages, RSI, and volumes, any change in promoter holdings indicating buying or selling by insiders, analyst upgrades, that is, people who track these companies frequently, what are they saying about it, and much, much more. There are like hundreds of variables you can find within a screener, but the big message I want to put forth here, and what I've learned in many years of doing this, is that there's a lot more utility in using simple queries over longer ones. What I mean is, if you type in a query that says, "Mujhe high sales growth chahiye, P should be low, give me high margin, good institutional holding, no debt, etc., etc., then it's very likely that you'll miss out on the 1 or 2 central factors that actually drives up a company's stock price. This is something Priyam, my researcher, and I do almost every day. We try to isolate the most important variables that can drive up a company's value, and the one thing that's really helping us get better and faster at this is the use of AI, artificial intelligence. AI does a lot for me. It helps me create interesting thumbnails, cleans up my newsletter, pulls financial data from different sources and organizes them. AI helps me summarize long articles, earnings call, presentations, and so much more. My point is, AI not only makes my life easier, it also helps me grow my business a lot faster. That said, is there a fear that AI might replace some elements of my work? Yes, absolutely. I'll be a fool to discount the fact that companies are replacing outdated skills with AI at an alarming rate, but therein lies the opportunity as well, with many high paying jobs going to AI powered roles that almost anyone can step into. These newer opportunities are coming in diverse fields like data analytics, personal branding, business strategy, content creation, and to leverage all of this, what one needs is the right knowledge, the right guidance, and that's where Growth School, the sponsors of today's video, comes in. The team there has put together an AI crash course that's designed specifically to teach you high income AI skills in just 180 minutes. This course is worth 15,000 rupees, but for the first 1,500 people who sign up using my link, you'll get access to this training completely free. You learn things like sorting complex data within seconds, framing a business strategy, building a personal brand using AI to find and secure jobs, negotiating salary hikes, and 25 other powerful and practical AI tools. Over 2 million people have already attended this training and boosted their careers. So do take advantage of this offer. It's just a matter of 180 minutes. Also tell your friends about it. And as always, the enrollment link is available in this video's description. Right, now let's come to section 2 of this video where we examine different investing strategies, many of which I have presented in my channel, and we'll see how a screener query for these strategies might look like. Let's start with growth investing, and as you might have guessed, there are three key variables to consider here: the revenue growth, the earnings growth, and definitely business expansion. For example, sometime last year, I did this video on GARP, growth at reasonable prices, and as a strategy, it uses a mix of revenue growth, EPS, and PEG ratio to arrive at a potential set of stocks. So this query is not entirely growth, it uses the valuation variable as well, which is not a bad thing, but that said, there is a problem here. You see, the PEG ratio that's displayed by most screening platforms is not entirely accurate. For example, when I checked it on screener.in, while the numerator took in the current P ratio, the denominator seems to be using the 5-year profit growth rate, while what it should be using is the expected EPS growth rate. Of course, computing the expected EPS growth rate is not easy. It requires a bit of work on your part. And in that context, Priyam is taking a session on this very topic on Alpha, the community I launched earlier this month. This session is on the 29th, so if you're an Alpha member, I request you to join in. And if you're not a part of it yet, then no worries, just give me a few weeks. I'll figure out a way to pass on the learnings and discussions to you as well. मतलब इसके लिए Alpha join करने की ज़रूरत नहीं है. Alpha has a lot more to it. But I should also add, like any community, it's a bit experimental, a little semi-structured, if I can call it that. At the time of recording this video, 52 brave souls are already a part of Alpha, and if you would like to consider it, the details are available in this video's description. Okay, back to the video. So GARP is one way of doing it, but there are more ways of building a growth query as well. For example, here's a small cap hyper growth query, which looks at sub 5,000 crore companies that have shown high year-on-year growth in this quarter and have done some serious capex in the past year. I have purposefully kept earnings growth out of this, as these are growing companies. They're likely to be a bit more volatile, which is where reading and researching more about these companies really helps. A third growth related query I came across is one that tries to identify disruptive and technology oriented innovative companies. Now, I don't think any of our Indian screeners will be able to execute this, but if you come across an advanced one, then what we're looking for are companies with high revenue growth, where R&D expenses are at least 10% of sales, year-on-year customer growth is more than 50%, recurring revenue is 70% or more. The gross margins are high, insider ownership is heavy, especially from institutional investors, and the market share should be rising really fast, as disruptors generally tend to steal market share from incumbent players. As I said, it's difficult to build a query for this, but if you get the opportunity, do evaluate innovative companies across these variables, and please do share that list with me as well. I love to feature it on Alpha. The next set of queries are from a classical and popular style of investing. I'm sure you've heard of it, the value investing strategies. Very simply, it's the art of buying undervalued companies with strong fundamentals, and we have three contenders here. Behind door number one is Benjamin and his NCAV rule. What is NCAV? It stands for net current asset value, which is the current assets of a company minus all the debt inside it. So on a screener, we have market cap is less than 2/3 of the net current assets, and the resulting companies, I wasn't expecting so many. So these companies are undervalued as per Benjamin Graham. Behind door number 2 is the Warren Buffett method. And while this is not as coherent as the Benjamin Graham method, a screener query here will include a mix of the current asset ratio, some debt related ratios, return metrics like ROE and ROC, sales and earnings growth, free cash flow, and finally the price earning multiple, relatively speaking. When I tried it on a screener, it gave me a rather good looking set of small and microcap companies, some of which I too have in my portfolio. And then we have door number 3, the trending value strategy by James O'Shaughnessy, that uses a combination of variables. The P ratio, price to book, price to sales, EV upon EBITDA, etc. And all these variables are used to arrive at a combined score, which is then, you know what? Why don't you just watch these 2 videos and you'll have a very good idea on how to identify companies aligned to the trending value strategy. Outside of these 2 big boxes of growth and value, your screening platform can also help you with a number of other investing strategies. So very quickly, you can build a coffee can portfolio for yourself using a combination of sales growth and return on capital employed. Again, I have a couple of videos on this. Then there's price momentum, and if you feel strongly about it, then try this query. It uses moving averages, 52-week highs, 3-month returns, volumes, and RSI to present a set of companies where the stock price is excessively accelerating. Earnings momentum is next. I think we have touched parts of this. So as a query, it uses a number of profit-related variables with a dash of sales growth and price momentum added to it. And finally, if you're keen on setting up a contrarian strategy, something like a loser's portfolio, by the way, iska bhi ek video hai mere channel pe, then explore a combination of falling stock prices, a low relative P ratio, but companies that are showing rising revenues and profits. Personally, I use many of the queries featured in this video in some way or the other, but if I were to single out a particular strategy, then I'll say from amongst the strategy queries, I use GARP at different points in time, and from the smaller situational queries, I'm often looking at 3 of them. The year-on-year quarterly sales growth, any big increase in gross block, and any visible changes in the operating margin. Okay, now I'm sure many of you will be tempted to mix multiple strategies in order to build your own custom screener. Please do go ahead, there's nothing wrong with it, but just a few suggestions. Number 1, please avoid using too many variables. A big bunch of variables generally leads to nothing workable, and instead try to pick only those variables that fit in perfectly with the strategy you're most enthusiastic about. Another suggestion, please use a screener only as a screener, in the sense that make it a point to always research the companies that show up in the results in terms of A, quantitative factors like the order book, new products, demand, supply, etc. And also for qualitative factors, which includes the management, competitive advantages, and sector tailwinds. In fact, here's something I say in almost every podcast I'm invited to. When you work on a screener, please remember it's a screener and not a picker. Even the website is called screener.in, not picker.in, and it's for the simple reason that screening of companies according to a certain criteria is just the first part of the process, and a lot more needs to be done before you can pick or rather invest in any of those companies. Number 3, please be very careful of false positives, which is a situation where the stock might look very attractive on paper, but this could be the result of sector cyclicity, a value trap, or it can be the result of the stock price or demand or margins being at their peak, which might lead to downward mean reversion. And finally, never forget, every strategy or query that you're fed in will have good and bad periods. And I'm not talking about just companies, even the strategies like growth, value, momentum has been going through a tough time for the last 6-7 months. So my point is, every few months when you run the query, it's likely to show a new set of companies, making it even more important for you to rigorously examine what enters and exits your shortlist. It's funny, isn't it? It took me an entire 15-minute video to tell you that there is no magical formula that can be put on a screener that will pop out a list of future multi-bagger stocks. Screening is just a starting point, first gear, if I can put it that way, and picking the right company from that filtered list is definitely a more difficult skill. Speaking of skills, don't forget to sign up for Growth School's AI crash course. Remember, it's free only for the first 1,500 people who sign up using my link, so don't miss out on that. And all said and done, I'll definitely encourage you to use a screening platform of your choice. Spend some time in understanding each variable. Start out with simple queries, always following it up with a more seasoned examination of the company. I do hope you found this video useful. Thank you very much for your time. Do like this video, subscribe to the channel, subscribe to my newsletter. Do check out what Alpha is all about, and I'll see you again next week. Until then.